20 years ago when you were at T. Rowe Price. You were an equities analyst, and you were given the role of metals and mining. And you've joked that that was only because nobody else wanted to do it.
No, that's actually literally what happened. Is that we had a guy that was metals and mining, and he had the opportunity to cover banks, which are a bigger sector, and he gladly took it. And I said, son, you just chose the wrong sector, right? He didn't get it.
As it turned out, he did. We know that back then the internet bubble had burst, and you started recognizing that money was flowing into gold, it was flowing into commodities, and this theory that you had was really crystallized by a visit to China. So can you revisit that time for us, and how is it that you eventually wound up with very large global positions in steel, in potash, and other commodities?
Well, thanks for your question, Mark. And I also would like to thank Red Cloud for the opportunity to come and speak to you guys. I hope it, whatever value the mistakes that I've made along the way can share will be useful for you. But back then, what I did think was interesting, is Lowell came in as a long-term friend of mine for 25 years now. One of the things I always like to do is kind of study history, rather than feel like I'm smart enough to just roll out of bed and figure it out like that day. I always like to go back and take a look and say, what happened in analogous periods of time. And so one of the things that I did, I bought the old CRB handbook. And that was, big book, 250 pages. It starts with aluminum, goes to zinc. And I bought it, and I spent the Thanksgiving of 2001 starting with aluminum and went all the way to zinc. And what was interesting to see was that in all the major commodity bull markets, gold always led. It was the first thing to rally. It was also the first thing to peak and go down. And gold had been working at that point for about a year. And so what it seemed clear to me was that I should be paying special attention to the basic material sector, particularly guys who are doing commodity extraction, because as the gold price went up, that would lead other commodities to go up as well. I later figured out the reason why for that is that basically, if you think back about your microeconomics 101, is that in the long term, the value of a commodity will trade at its marginal cost of production. And what gold is doing when it's going up in value is it's reflecting the devaluation of currencies, which means by definition, commodity marginal cost of production going up. And so it was very easy on that basis to be kind of bullish on everything. And so I had the good fortune of kind of showing up, and people were just tired. They had been beaten into submission for 20 years, and people couldn't find it in themselves to be bullish. We used to say the higher for longer commodity club. There were 4 of us. We could hold those meetings in a phone booth. And what was really eye-opening was, so I was stalking a catalyst that was huge global change, and I kept looking for it, and I couldn't figure out what it was. And then I went to China with some friends in 2003, and I was like, oh shit, this is big. I get it, right? And then I was able to go home and then finally have the causality for the thesis that I had laid out. And so there was value everywhere, and we were smart enough to pick it up, and then we were smart enough not to sell it, because there were a lot of deep value people that were there with me at the time, because you had to be kind of crazy to be buying these things. Lowell and I were talking about it. I placed a big order. I think we did 10% of the Agrium deal in March of 2002. And, we just held on to those things. A lot of people bought them and sold them.
Right. You said a lot of your colleagues and former colleagues actually sold too early. Now, you've said that decades can be summed up in a word or two, and the current operative word that you're using is deglobalization. You've also said that similar to the early 2000s, when there was a big tech revolution that eventually, came to fruition eventually, but we know what happened in the markets. Now we have AI, we have Mag 7, and it could be stretched. A lot of people think maybe we're in a bubble, maybe it's peaking. And you believe that large money, if it hasn't already, will be reallocated. So can you expand on that?
No, sure. Well, definitely one of the frameworks that I've developed over time, and again, this is just what works for me. I'm a liberal arts guy. I never used Excel until my first day at Wharton, which I don't recommend you doing if you want to feel smart about yourself. But so I just try to bring that framework to it. And so one of the ways I try to think about the world is really like every 10 years or so, right? The most important thing at the end of a cycle, everybody can describe it simply. So the key is to figure it out early. So in 99, 2000, everybody knew it was the internet, right? And that drove all the performance. And then, of course, the next cycle that I was fortunate enough to be early in really was the industrialization of China. And so I was able to see that in '03 because I was aggressively looking for change, and so I was looking under a lot of rocks. And a lot of people kept waiting to go back to tech. They kept waiting for tech to work again, and of course it didn't. Not until the last 10 or so years. But then, so if the industrialization of China was the 2000s, I would say 2010s were kind of the rise of the iPhone ecosystem. Apple created the iPhone in '07, and it was remarkable, right? Because nobody knew that they wanted something they could put in their back pocket and organize their whole life around it, you know, in terms of all the things that it helps you do. Now, of course, we all have one. And because, you know, everybody had one, then you spent more time on Facebook because it was mobile. And so that whole ecosystem grew up around that of many parts of the Mag 7. But I would argue we're somewhere close to saturation on that. And so when I do look at the world now, you know, and try to say what's the biggest change underway, I'm really trying to simplify it and say, at the end of this, people will come to understand that simplicity. And so I want to understand it now so I can invest in all the manifestations of it. And I do think that's kind of de-globalization. And I think that started with Brexit in 2016. Clearly, Putin's war in Ukraine, you know, bringing land war to Europe for the first time since World War II, that's a huge deglobalization shock. The Trump administration has brought forth a tremendous number of deglobalization initiatives, and it's clear to me that the world's kind of fracturing, right? And so for me, I'm excited about what I think we can do investment-wise against that, because when I put that into context, I think that's the biggest change since World War II, right? Because at the end of World War II, I mean, we burnt the world down, and there was winners and losers, and everyone knew, you know, what seat they had. And then the world progressed for 80 years, you know, with the world kind of shrinking, and it eventually had one big factory in China that made everything and sold it to the rest of the world. And I don't think that works anymore. And so I think if that world doesn't exist, then people are going to need to embrace the reality of a changing world, which means trillions of dollars of CapEx to get in the right place. And I think resources have been starved for CapEx for a tremendously long period. And of course, like the Mag 7 guys are spending like drunken sailors in terms of AI, and I get it, but you know, CapEx booms don't tend to end well. And so we'll see.
Having said that, are you looking around the AI data, the data center boom, and looking for maybe infrastructure plays, or is that sort of further up the cycle for you? And in the meantime, you're more focused on gold-related investments. I understand you have anywhere from 30 to 50% gold-related investments in your portfolio.
Yeah, certainly. So I run one of 8 strategies that my company operates, which is far better than the first 5 years when I ran like every nickel of the firm. So this is much better. But definitely we were fortunate enough to catch some of the AI kind of infrastructure early on. But as a value guy, I struggle with a lot of the valuations. And so either we're in more esoteric ways, but I do really feel that we are early in this gold-led commodity cycle. I mean, gold really only broke out in February of '24. So we do have very meaningful gold-related positions. It's probably 45% of the diversified equity portfolio that I run on a global basis, and that's been very useful for the last year and a half. And I don't think it's over yet, because one of the things that I've focused on is just it's really remarkable how strong gold has been relative to other commodities. It's very historically unusual. So as an example, just the pace at which gold is moving, it has only moved at this pace 2.3% of the time in the last 120 years. And those were all periods of great unrest. And so according to the gold market, you know, which is just a function of everyone buying and selling, that this is a very special time, maybe even a scary time. And instead I have equities at all-time high and people are feeling great. And so that doesn't seem right to me. And so I feel like I'm still okay owning the gold, but you know, time will tell.
You've said that gold is always the smartest person in the room. It always leads, and it's always telling us something. So you alluded to a lot of it there, but what has gold been telling us the last couple of years and currently?
It's a great question, and I really spent a lot of time trying to think about it. I don't know that I have all the answers, but I definitely think that gold has proven to be a deglobalization beneficiary, just like, let's say, the foreign defense stocks have been. Because as the world is changing and people have woken up to how the fact that, I don't know, you're in Poland and there's a land war next door in Ukraine, they're spending, what, 5 or 6% of GDP rearming. They don't need us to prod them. So I think clearly the world has changed in that way. And I think, frankly, the gold trade is to a large extent driven by that as well. Because if you take a look at what's new this cycle in the gold market, it's that central banks are back buying for the first time really since the 60s, right? Because central bank accumulation peaked at like 36 or 37,000 tons in 61, 62, and kind of has gone nowhere since then. I mean, I don't know what nominal GDP is up since then, 100 times, and the gold reserves are flat. So it makes sense to me that there's a huge deficit of these new buyers in terms of the central banks that are buying these things. But in my opinion, a big part of that prompt, why recently, it really took place after the West essentially grabbed Russian central bank assets. And I think that was a big eye-opener for people, that if for whatever reason we didn't like you, we would just take your stuff. And I think that brushed people back a little bit. And so you started seeing two new drivers in gold. One was the central banks, and the other was Chinese retail. I mean, the price even today in China for gold and silver is both a premium to the West, and so they're just draining physical out of the West.
Now, we're going to keep diving into gold here. You believe it has two dimensions, one of which is its relative value compared to other assets. So what are those two dimensions? Can you flesh that out?
Well, sure. Well, of course, price is the easy one because that changes every day, but maybe you guys are better gold price forecasters than I am, but gold always finds a way to humiliate me in terms of what I think it's going to do in the short run. And so frankly, I think it's very challenging to forecast, let's say, the price of gold. But what's interesting to me is there's a lot of information in the relative value of gold. And this was actually something, of course, that Pierre Lassonde first talked about in 1998 when he was at Franco, talking about the Dow to gold ratio, which was the first time I ever heard anybody talk about that. But so if you look at gold relative to, say, an index of commodities, I was looking at this the other day, the strength in gold relative to commodities, it's basically unprecedented. And of course, crude's been a pig of a commodity and gold's exploded. It's been very different experience in terms of what commodity you own in the chain so far. But the nature of gold's outperformance relative to, say, commodities, I mean, it's really only done this prior 3 occasions. In this kind of explosive outperformance, global financial crisis, Great Depression, and COVID, and now. And so again, this is why I continue to hang out with these big gold positions is I'm looking for a news catalyst that's COVID-sized or global financial crisis-sized. And when I see that in the headlines, then I think I'll take some profits and I'll try to find something else smart to do. But it just seems to me like we're not there yet.
You touched on this earlier that in terms of this gold cycle, you're kind of saying it hasn't really even started. It's not even in early innings yet.
No, I mean, I've had this conversation with people like me that have been around for a few cycles, and yeah, and that was a conversation I was sharing this with a good friend of mine, John Roque, who's at 22V. He's a long-term technical analyst for anybody that follows him, and John has a great ear for these things. He talks to a lot of people on Wall Street, and I kept telling him, and I said it feels like we're like the first inning, and then he actually had the insight to say, well, he said it's not even the first inning, like they're just singing the national anthem, because what he was saying is he's seeing no interest in it, which is hard to believe given the explosive price action. But the more I think about it, I do think that's true. I think it's exceptionally early because I would date the beginnings of these cycles in terms of relative capital flows, and people are still making money speculating in tech. So the people who, the new investors who are showing up in gold, again, it's Chinese retail responding to the biggest real estate collapse, in world history. It was a Chinese real estate got to be a $100 trillion market cap, which was the world's biggest asset class, and that's deflating now. So it makes sense that Chinese real estate would be buying to try to hedge the bank-driven recapitalization they're going to need. That makes sense. Same thing happened in the U.S. in 2005 and 6. Number one, and number two, central banks, right? So I think the orthodox start for the cycle will be whenever tech flames out. and retail starts seeing the wisdom of diversifying their investments.
And we see it on the cover of Time Magazine, maybe, to use a dated reference, something like that. It becomes mainstream.
Well, yeah. Just a few kind of quantitative examples, right? Like those of you who may have been around for a while, you might take a look at the Central Fund, which used to be the Sprott runs now. Central Fund used to, and that's trading at a 7 or 8% discount to net asset value, which is no enthusiasm. Like it was at a premium the whole from 2001 to 2012. It's a discount. Chinese prices in their international exchange are at a premium, both in gold and silver. And if you take a look at the shares outstanding in the GDX, large gold equity ETF, the shares outstanding are down 25 or 30%, in a year. I mean, where's the retail enthusiasm? I mean, I don't see it. I mean, in my wealth management company, we manage money for 1,720 families. I've now had 4 inbound inquiries in the last 6 months that are gold related. 4. It just doesn't feel to me like it's overdone.
Right. Louis, you've already given us some historical perspective on gold. Let's keep that going. You believe this cycle is much different than the previous cycle. So can you compare and contrast them?
Yeah, no, that's great. I mean, and again, like one of the things that I'm trying to devote a lot of mind space to is to say, what are the real fundamental things going on? Because typically those big fundamental drivers will have 5 or 6 or 7 different applications that are all driven and trained by the same fundamental development. And so I'm really trying to figure out like the animal in its whole context. And so when I look at that in terms of how this cycle could be different, of course, the central banks have a seat at the table now. I mean, that has never happened. I remember, many years ago when I got active in the sector, I think one of the first gold conferences I attended, and it was, old men with white hair coming out of their ears, right, and smelled like mothballs, and I was a funny 32 or 35-year-old at the table, and they would talk about, the, conspiracy theories and involving central banks and this kind of stuff. But I remember spending some time with Pierre Lassonde back when he was running Newmont, and I was a large shareholder, and he was active in the creating the GLD ETF on behalf of the World Gold Council. And he had spent all this time with the central banks. He said the central bank can't spell gold, right? And I mean, he had no incentive to lie to me, and so I'm sure he was telling me what his view was. But what was interesting about that is that's not the case now. I mean, what you can see in the visible numbers are almost 1,000 tons per year of central gold accumulation. Back in the days of the gold standard, central banks would buy 40 to 80% of the world's gold supply every year, and it kept up with GDP. So as their GDP grew, they would buy more gold. And these guys haven't bought any gold in essentially 60 years, and they're buying it now. So the physicality of the gold market is new and different, because I think gold was very much an artifact of Chinese-driven boom in things like iron ore and this kind of stuff, or potash back in the day, right? But this beginning is very different, and I think it'll change over time. I do think you'll see more Western interest in it as equity markets at some point start to disappoint people, which I think is inevitable given their lofty valuations.
Louis, you've said that you think that China is lost in terms of engaging with the West, and that the result of that is going to be 2 orbiting systems, one around China, one around the West. Can you expand on that idea?
Well, yeah, and again, this is just my framework. It doesn't have to be reality, although I think it is. And I just try to keep it really simple. Another way to go back to tie this together with that concept of the relative value of gold, is that basically when the world is kind of a safe place, gold is kind of a nonsensical thing for people to own, because as Warren Buffett's famously pointed out, it never grows. And so, but the wisdom of the market has it outperforming any other asset class on the planet. So the market says this is a time to own it, or it wouldn't be outperforming. So that's interesting. So why might that be? And so I think, again, trying to keep it simple, I think at the end of World War II, it was like the U.S. and the Russians. I mean, remember the United Nations was the name of the Allies, the formal name of the Allies that successfully fought World War II. It was literally called the United Nations. And then if you take a look at the 5 permanent members of the United Nations, they were the well, the four victors in France, because Charles de Gaulle was a huge pain in the ass, and so they let him get on anyway. But really, it was right. It's the Germans don't sit on the UN Security Council. They're not permanent members. It's the U.S. It's I guess the Russians now, used to be the Soviets, the English, the Chinese, who we let on. FDR wanted on, and then France, right? And so we literally burned the world down, cemented our governance over it, capped it with a governance structure that we controlled, and then we progressively lost control over that. And the Chinese did a wonderful job of taking that system and working it to their advantage. And so if you take a look at who's in whose camp, I mean, the Chinese are backing the Russians who were in Ukraine. The Koreans are also helping the Russians. There's the Iranians. I mean, it's kind of a not so nice neighborhood they're creating, at least people that maybe don't value Western values or whatever. And so if the world is really retrograding to essentially the fact that there's now a disagreement about what the rules of the world ought to be, then it makes sense that gold is a safe asset that is no one else's liability. It would make sense that would be a thing to own. And so I think it has been a prime winner in this deglobalization trend.
So if gold is leading the way and commodities will follow, what sectors, and you're not going to talk specific names, but what sectors do you like right now in commodity? What appeals to you and how do you get exposure?
Well, last time everything worked. I think this time everything will pretty much also work. So the way we're trying to prioritize the world is valuation. So there's a number of agricultural companies that are trading at fractions of book value, and companies that are making fertilizer products that farmers use as inputs. Those are trading sub-book. There's a number of steel-making conglomerates in Europe that are 0.6 times book, 0.3 times book. And so as a value guy, the way I'm trying to step out from these initial gold investments is really areas that I think have limited downside for that reason, or as the world continues to change, things that may be deglobalization beneficiaries. I mean, sadly, we had positions in uranium, and I wasn't smart enough to hold on to those. And so there have been a number of things that we've traded out of, prematurely. But I really feel like that the cost pressure that gold is showing will show up when growth returns to the world. And I don't know at what point that's going to be. But because gold has had these exceptionally extreme moves relative to these other commodities, which is emblematic of a time that's not great economically. Although the headlines don't seem to show that, but the relative prices show it.
You mentioned, Louis, that at Capital Wealth Advisors, you run, not you personally, you and your colleagues run 8 strategies. You run one of them. Can you describe that? And again, maybe get into the fact that a lot of that is gold.
Well, sure. So we started the business 12 years ago. It was pretty much a startup. The latest ADV has us about $4 billion under management. And so one of the things that we've tried to do is having people like me, supposedly pointy-headed research people with a background in this stuff, is to try to present a suite of professionally run products that our advisors can mix and match relative to individual client needs. So they're all tools in a toolbox. So they're not made, it's not an art form. These have utilitarian use. And the utilitarian use of the strategy that I run traditionally was essentially widows and orphans, right? Or maybe another way to put it, our headquarters is Naples, kind of a Naples retiree demographic, which was, somebody an entrepreneur that built a plastics factory and sold it, had enough money where didn't have to work again, wanted to know the money was managed thoughtfully, professionally, with risk management in mind, ideally maybe an above average dividend, more resilient on the downside. And so all these things kind of fit me personally as a value guy. And so so the portfolio over that time has very much retained those characteristics. A couple of years ago when I thought the tech was a little bubbly, which of course was premature because it got more bubbly, we started taking these positions in gold, because typically gold as a hedge asset is something that performs very well when equity valuations go from a high place to a low place. and equity valuations are very high. And so I felt like that would be a good place to start the secular move of leadership in commodities, which I anticipated being part of this deglobalization change. And then that actually worked maybe earlier than I would have thought, really because of how the cycle is different, because you've got Chinese retail participating in a tremendous extent and central bank buying.
And can you elaborate on your philosophy that global markets are changing? As I said off the top, the old world order is over. Investors should look for, but not just look for, and embrace this change. And that's how you find the future winners.
No, for sure. That's definitely been my methodology. I really I kind of consider myself kind of a change guy. You know, there were a lot of people early on in my career, and they were like, "Lewis is a commodity guy." I mean, I became a commodity guy because that's what was changing. And again, you had a bunch of old timers where it had been a sleepy sector, and everyone got comfortable that because they had been studying the same world for 20 years, that made them an expert. But because the world was changing in a way they didn't anticipate, they weren't an expert, they were actually roadkill. And there were people that overinvested based on the expertise they thought they had because they had studied one thing for a long time. But if the world was changing, then all their knowledge was crap. And in that case, it was. And so, of course, they tossed all those guys out who tended to be more conservative because they're all range traders, because that's how you live through a 20-year bear market. And then, of course, they replaced them with fearless 26-year-olds at the peak, and all those kids went right over the cliff in 2011 and 12, and they all blew up, and so they all got fired, and then they brought in more conservative people. And so I still feel like we're very early. So if you take a look at just some of the big gold seniors, for instance, I mean, what are they doing? They're selling assets and buying stock back. You know, what they're basically saying is, I'm so sorry I lit all your money on fire, and I'll never do it again. And to try to demonstrate how I've really got religion, you know, I'm doing all these capital efficient things that I should have been doing 10 years ago. And so it just feels to me like we're still early in that cycle. And so there are people who are selling the breakouts. And if the world is really changing, which is a big if, then the job of leadership is to keep working and to demonstrate through price performance that world has in fact changed. And so if you just look finally at this, I look at a lot of price ratios. And so one of the things I've been watching with interest is, let's say, the gold stocks is defined by the XAU index relative to semiconductor index. And semiconductors have been lagging gold for a year and a half. I mean, why is that? I mean, the market's pretty smart, you know, you would think. And so AI seems to be real. People are spending trillions on it. But why is it that outperformance is actually coming from this strange little gold sector that no one cares about? I mean, I think that's interesting.
You've had a lot of successes in your career, which you've touched on. Yeah, you also freely admit you've made mistakes, like we all have. So let's start with the mistakes. What was the biggest one? What did you learn from it? And then after that, let's get your biggest win.
How much time do you have? This is going to take a while, but no, it's funny, right? There's a great quote from Niels Bohr, the founder of quantum physics, and he said, "An expert is someone who's made every mistake that can be made in a narrow field." And so I'm definitely an expert when it comes to kind of commodity investing. But there have been a lot of mistakes. I mean, the one that I think I remember a lot was Monsanto. I was a very ardent holder of Monsanto when it IPO'd from Pharmacia 2001, you know, I was dating myself, because I thought their agricultural biotechnology was really interesting. And so we built up a large position in it, and I did a lot of work on it, and the stock was working. And some of the work that I did revealed a couple flaws, and in conversation with management, they didn't seem to share my concern about it. Like, they had a huge receivables problem in Argentina, Brazil, and they had been stuffing the channel to get ready to IPO in terms of Roundup in the U.S., and I felt like if both of those things worked against them, it could be bad. So we ended up selling it well, and so I felt really good, which is typically how investing mistakes begin, is you feel really good about something. And then, of course, it went from like $36 a share to like 12. And because I was so pleased with myself for avoiding that, I didn't do the smart thing, which people begged me to do. And they said, like, clearly you understand this company. Why don't you, it's fallen 2/3. Why don't you take a look at it? You know, and I looked at it and I said, you know, I don't trust any numbers in the balance sheet. And management lied to me. And I had, I guess, one of my early mentors in the business D-value guy come into my office and he said, well, why don't you do a replacement cost analysis on their glyphosate assets where they were the world's biggest producer? He said, do you trust those tonnage assets in terms of their capacity? I said, yeah. And he said, well, would you do that for me? And I said, no. And then the stock went up 10 times, in 6 or 7 years. And it was a huge mistake because I could have bought every single share that traded, and I did know it very well. And so what I took from that, is that your biggest mistakes typically are not the things that you own that go poorly. It's the things you should have owned for very good reasons and you don't. And so, I left 10 or 12 times my money on the table on that. And so that was just, but it started from a position of me being smug and feeling like I was the expert and I was really smart and I had sidestepped this disaster and I should have been much more open-minded.
So I was going to say that there was some hubris involved as well.
Oh yeah, yeah. No, it was a very painful lesson to learn. But definitely, it's one of the things that I try to think of now is just to be open-minded that, anything can happen, and it's far better to explore how you're maybe wrong, and to understand, say, the bear argument for the things that you like better than the bears, because that's just you're going to live longer and your numbers will be better.
And your biggest win, was it recognizing the commodity cycle in the early 2000s?
Yeah, that was that ended up being a nice money-making opportunity for the clients that I had at the time. Mostly were T. Rowe Price, shareholders. We owned 10% of the North American steel industry, and that would end up going up like 12 times. And we ended up 8% of the North American fertilizer industry, and that went up 25 times. But I had left T. Rowe before those ultimate peaks and everything. But that was fun, and it was very eye-opening too, in terms of the nature of big cycles. Because what I took from that was that Lowell remembers how bullish I was. I just exuded bullishness like you couldn't keep me in the room. I would scare you, because I was so bullish. And then so I had these price targets that were a joke in retrospect. Like I thought. Potash Corporation in Saskatchewan would go up, maybe 3 or 4 times. I thought Nucor would maybe go up 3 or 4 times. Nucor went up 12 times, Potash went up 25 times. I was just so wrong. And so that was useful for me in trading the financial crisis, because at the start of that, if you understood that that as the housing stocks were falling, the housing equities were falling in early 2005, that would mean that housing values would also go down, but that mortgages, which were collateralized by those housing assets, were the leveraged assets upon which the U.S. banking system, in which it held its reserves, that by definition, the financial system was going to basically go bankrupt. And so it was going to be a problem. And so I thought I was sufficiently bearish in early 07, and I was not bearish enough. And so now that we're in what I think is a very large commodity cycle of big duration, I'm really trying to be as bullish as I humanly can to be commensurate with the size of the opportunity that I think it is. Time will tell if I'm correct.
Okay, I've got a couple more questions for Louis, and then we'll have about 5 or 6 minutes for Q&A. We have microphones on either side of the room. Put your hands up, please, and we'll get to you. So lastly here, a couple of questions here. Lastly, I mentioned off the top you live in Naples, Florida. I understand you like to start your day with a walk on the beach. So how does that give you clarity? How does that give you calmness in uncertain and volatile times?
Well, I think that's a really important part of trying to set yourself up for success in the market. Is my conclusion was that it doesn't take amazingly penetrating brilliance to see things. The most important asset you have is to have an incredibly open mind, number one. And then number two, I think the ability to kind of stay calm in a position. So like as an example, and walking the beach in the morning is very useful for that. So back in, I remember 2003, 2004, I accumulated $500 million at cost in the U.S. steel industry when 45% of it was in bankruptcy, which was a large position. And I thought it was a very easy decision to make because the Chinese steel price was the highest price in the world. And the U.S. was dependent upon imports. And so I felt like I didn't have to worry about anything else until the Chinese price was not the world's highest price. Well, about a year later, the Chinese price was not the world's highest price. And so I didn't sleep for 2 days. and I poured over all my little spreadsheets, and I just worried myself to a frazzle about, did this mean that I should sell these things? And and frankly, it could have gone either way, because I kind of worked myself up in a very unhealthy way. And then I was able to kind of calmly see that the valuations were great, and there were a number of other things that would have to take place to put the top in the cycle. And so if I had not been calm enough to sit on those gains, it would have been very easy just to press a button. And so I think you have to kind of stay in the game. But I don't think that's an intellectual exercise. I think the intellectual part's probably the smallest of them. I think it's just more staying open-minded.
Lastly, Louis, is there anything we haven't touched on that you'd like to get across to the audience?
No, I'm personally having a lot of fun because I love change. I think change is taking place. I mean, we're very fortunate to be in a business that allows you, kind of pays you to be intellectually curious, and so I feel really fortunate about that. I'm so excited about how the cycle's unfolding. The only thing I guess I kind of keep coming back to, or wish I had the answer to, really is again, if I could see it with clarity toward the end of the cycle and just work backwards, right? Because at the end, everyone will know what it is. Like just right now, it's AI, right? Well, at the end of this cycle, it will be very, very similar. And so I think figuring that out early, like maybe one final funny little story, and also impossible. I remember I had been going to China since 2003, and it was always kind of crazy Louis going to China. And I kind of drugged people kicking and screaming along with my investment thesis. And so I was going to China once a quarter, and one day in July of 2007, I think I bumped into Lowell in the Beijing Hilton, and then not one, but two of my former T. Rowe Price colleagues in China. And I've been going to China for 4 years and never seen any of these people. And I asked them, I said, what's going on? There's two of you here now, right? And they said, well, word's come down from management that China is the future. And so we're all on a plane over here to learn about China. And I looked at them and I said, China's over, right? Because you're here. And it was July 2007, and that was kind of the peak, right? And so I think we all have to kind of live. I think our performance would be better if we could live in that area of uncomfort where we're embracing controversial, things and kind of willing to look stupid. And so I kind of feel, I guess in conclusion, I've been doing this for so long, I made so many mistakes. I mean, I don't think it bothers me anymore. It's just like breathing. And so I clearly want to make fewer mistakes than more. But I just think we're all very fortunate to be able to be active in this business.
Right. So be comfortable being uncomfortable is what you're saying.
Oh, yeah, that's great.
Okay. Who do we have? Who has questions? The lights are bright. I can't see that well. Anybody? We have Vanessa over here with a microphone, and over there as well. Huh. All right. Let's keep going then.
I did such a good job. I answered all the questions. That's amazing.
Everybody is dumbfounded.
That's amazing. No, that must be it. That must be it.
Okay, I think this gentleman here. Okay, just wait for the microphone, sir.
Great presentation. I'll just say a couple comments you didn't talk about. First of all, I don't think gold is a commodity, so I honestly don't think they're related. It's money, totally different set of parameters. And you never talked anything about the gold-backed crypto. I understand Tether, the largest stablecoin in the world, is moving big time in gold-backed coins.
No, definitely. That's a great point. Well, look, I completely agree with you. Gold really is a currency. Gold's a best currency chosen by the market, which is why it trades like it does. People misclassify it as a commodity, number one. And I guess number two, I was at the Denver Gold Show just a couple weeks ago, right? And that was one of the new events, which was the Tether guys who showed up. They take this big stake in Elemental, and apparently they've taken large stakes in a couple of other royalties as well. I mean, they have a lot of money, so we'll see. But I think that's probably the vanguard of maybe American retail. Like, the cycle really can't progress to its next level until American retail is participating, or at least it can't get toward the heart of the cycle, in my opinion, until it happens. So perhaps the Tether guys are the front end of that. It would make perfect sense to me. I mean, I'm very much looking for a catalyst of that magnitude. Perhaps that's it.
We hear a lot about the adoption of a central bank digital currency. What are your thoughts on that subject?
Central bank digital currency.
Oh, well, you know, the strategy that I manage hasn't really been active in crypto, and so what this means so far is I've left a lot of money on the table for people who embraced it. You know, but I mean, again, in terms of, I look at this through the lens of kind of U.S.-Chinese competition, and it's clear that the Chinese are betting on something gold-centered, and I think the U.S. is trying to bet on something cryptocurrency, stablecoin based to create demand for U.S. Treasuries. So I think those are the camps. I mean, we'll see how that wins. Although my understanding of crypto is that they can kind of track it continuously, kind of everywhere in every way. And so I don't know that that's necessarily accomplishing some of the same things that gold ownership does. But I understand the people that see the similarity.
All right, we're at time. We're going to wrap it up. Thank you very much, everybody, and thank you to Louis Johnson. Great stuff.